Recently, the stock market has shown a strange phenomenon. Some publicly listed companies, originally with nothing to do with crypto, suddenly announced that they've bought Bitcoin or hold Ethereum, and their stock prices skyrocketed by 200%, even 300% in a single day, like they've been injected with adrenaline. But what's really behind all this? What secrets lie behind this? Is this Wall Street's new wealth code, or just another financial scam? Today, we're going to take a close look at the crypto stock linkage. So, what exactly is crypto stock linkage? In simple terms, it's about connecting the digital currency and stock markets to manipulate capital. So how exactly do the crypto space and stock market connect? There are mainly 5 models. The first model is that publicly traded companies use their own funds or raised capital to buy cryptocurrencies like Bitcoin or Ethereum. The pioneer of this approach is a company formerly known as MicroStrategy, which has now rebranded to Strategy. As of September 2025, Strategy has accumulated 640,031 Bitcoins, worth over $73 billion. It is currently the publicly listed company with the largest Bitcoin holdings in the world, and at one point held 3.048% of the total Bitcoin in circulation. However, when the company was founded in 1989, it initially focused on software and had absolutely nothing to do with digital currencies. Its founder, Michael Saylor, didn't take Bitcoin seriously in the early days, but when the global pandemic hit, he realized that the US's long-term loose monetary policy was causing massive capital inflation, and that Bitcoin is both an inflation hedge and a reserve asset that won't depreciate. He believed this was a way to position his company ahead of future institutional liquidity. His logic was bold but compelling. If Wall Street allocates just 10% of its assets to Bitcoin, its price could hit $1 million. So, in August 2020, Strategy made a shocking move, spending $250 million to buy Bitcoin, becoming the first public-listed company to take that leap. Initially, Wall Street Capital looked at Saylor's move with a mocking attitude, treating it as a joke. And in 2022, when crypto entered a bear market and Bitcoin's price crashed, MicroStrategy posted a net loss of $1.47 billion that year. Still, Saylor's strategy was simple yet unshakable. Keep buying Bitcoin, hold indefinitely, and make it part of the company's core structure. And he did just that. Year after year, Strategy kept buying Bitcoin. And you can see Strategy's steadfast strategy of buying and holding Bitcoin from this chart. As of the release of this video, the latest update in September 2025, the company made another purchase, 196 BTC, at an average price of $113,048, spending $22 million in total. Over 5 years, it amassed 640,031 Bitcoins, now worth $73 billion. After surviving the bear market, Strategy stock began to move in sync with Bitcoin's price, skyrocketing from $14 per share in late 2022 to over $400. That's a jaw-dropping 2,300% increase. The second path is the crypto-native companies go public themselves. For example, Marathon Digital, the second largest public Bitcoin holder, completed its IPO on NASDAQ in 2021 as a publicly listed digital currency enterprise. As of September 2025, Marathon owns 52,477 Bitcoins, worth about $6.3 billion, and its stock price has been soaring ever since. The third path is through reverse takeovers, or shell company mergers. A perfect case study is SharpLink. SharpLink was originally a struggling small company on the verge of delisting from NASDAQ, with a stock price once below $1 and shareholder equity of less than $2.5 million, facing immense compliance pressure. But it has a killer feature, the NASDAQ listing identity. This shell attracted the attention of crypto giants, including Ethereum co-founder Joe Lubin's ConsenSys. Subsequently, ConsenSys, together with several venture capital firms in the crypto space, such as Parify Capital and Pantera Capital, acquired SharpLink through a $425 million private equity financing round, and they issuing 69.1 million new shares at $6.15 each, raising $400 $425 million in total. They then used that money to buy 163,000 ETH, packaging it as the Ethereum version of MicroStrategy and claiming that ETH is a digital reserve asset. This is SharpLink's flywheel effect. Fueled by Ethereum's hype, SharpLink's stock exploded. Investors seem to forget that SharpLink itself was originally just a gambling company. The company even planned to stake its ETH holdings on the Ethereum network, locking them in exchange for an annual yield of 3% to 5%. Another route is through SPAC mergers, special purpose acquisition companies that exist solely to take private firms public. For instance, Trump Media and Technology Group and Crypto.com both went public through SPAC deals, transforming into publicly traded crypto companies. The fifth route is that some existing listed companies transform themselves to enter the crypto space. For example, Riot Platforms Company. It was originally a biotech firm, but when that business failed, it shifted to Bitcoin mining in 2017. As of September 2025, Riot holds 19,309 Bitcoins, worth about $2.39 billion. Other global giants also hold cryptocurrencies as part of their balance sheets. Tesla still holds over 11,509 Bitcoins. Galaxy Digital Holdings owns 17,102 Bitcoin. Japan's hotel management company Metaplanet has 20,136 Bitcoin, and Canada's Hut 8 Corp holds a massive 102,778 Bitcoin. In total, over 100 publicly traded companies now hold Bitcoin or other digital assets. So the question is, why are crypto companies and traditional firms going through all this trouble just to become publicly listed crypto companies? Many cryptocurrency investors believe that digital currency is different from gold, which has high storage, transportation, and authentication costs, and also different from cash, whose value can be eroded by inflation. A token like Bitcoin is digital, borderless, and protected by a decentralized network, making it more resistant to political interference. And did you know there are only 21 million Bitcoins in the world? However, statistics show that by the middle of 2025, nearly 95% of these 21 million Bitcoins had been mined. This means there are only about 1 million left before the supply cap is reached. For this reason, crypto titan Michael Saylor believes that Bitcoin's price could eventually reach $1 million per coin. Bitcoin serves as both an inflation hedge and a store of value that won't depreciate. Michael Saylor even suggested that Trump sell all gold holdings and swap it for Bitcoin as a reserve asset. As investors remain bullish, they keep buying cryptocurrency, but where does the money come from? Through compliant financing. Therefore, crypto companies have been trying to go public to access more legitimate channels for raising funds to buy crypto. So how exactly does crypto stock linkage make money? Generally, a typical publicly listed company has a treasury department to hold and manage assets. It usually hedges risk through a diversified portfolio that includes foreign currencies, gold, bonds, real estate, or art. However, when more than 50% of a crypto stock linkage company's treasury is held in digital currency, the company effectively becomes a DATS digital asset treasury company. The core idea is simple. The company first raises funds from the public markets by issuing stock or bonds and uses the proceeds to purchase and hold its chosen digital assets, and then uses those digital assets to secure more low-cost financing, creating a flywheel effect. Now let's examine Strategy, a textbook example of integrating cryptocurrency and equity, to delve deeper into how this crypto stock linkage money-making flywheel model works. First, the company raises funds by issuing low-interest or even zero-interest convertible bonds. For example, in mid-2024, Strategy raised $800 million through a convertible note offering about $786 million net at a 35% conversion premium. The funds bought 11,931 BTC at an average of $65,883. Another deal worth roughly $600 million followed soon after. These bonds allow investors to convert them into company stock at a fixed price in the future, while enabling the company to obtain cash at extremely low cost. The funds raised were then used to buy Bitcoin in multiple rounds. In addition to debt, Strategy also attracted investors by issuing preferred shares. For example, Strategy recently launched Stretch Preferred Stock with a variable dividend starting at around 9% per annum, and the proceeds are explicitly marketed for funding Bitcoin purchases. In July 2025, Strategy expanded the planned size of its $500 million stretch offering to $2 billion, highlighting investor demand. Finally, Strategy leveraged the premium effect from Bitcoin's price increase to kick off the flywheel effect. When the price of Bitcoin rose from $10,000 in 2020 to $100,000 in 2021, 2025, the value of company assets significantly increased, attracting more investors to buy stocks. The rise in stock prices then allowed MicroStrategy to issue bonds or stocks at higher valuations, raising more funds to continue buying Bitcoin, thus forming a self-reinforcing capital cycle. The core of this flywheel model is the combination of low-cost financing and high-return assets. Strategy borrowed money at nearly zero cost through convertible bonds to purchase highly volatile but bullish Bitcoin, and then leveraged the market's enthusiasm for cryptocurrency to amplify its valuation. This approach not only changed Strategy's asset structure, but also provided a textbook example for other U.S.-listed companies. Strategy's stock price has also risen from just over $10 per share in 2020 to around $400 per share recently. So how do ordinary investors evaluate the potential value of these DAT companies? How much is each share actually worth? There are two recognized key metrics. One is NAV, net asset value, which primarily measures how much value each share has. NAV equals open parenthesis, total Bitcoin holdings plus other assets minus total liabilities, close parenthesis, divided by open parenthesis, total outstanding shares, close parenthesis. For example, a company holds $10 million in Bitcoin, has $100,000 in other assets, total liabilities of $500,000, and 10,000 shares outstanding. According to the NAV formula, the NAV comes out to $960 per share. In our example, the company's NAV is $960 per share, while the stock trades at $1,000 per share, meaning the company holds $0.96 in asset value for every $1 invested. Generally speaking, due to high demand for Bitcoin, the current market is unlikely to see a value exceeding 1. Because Bitcoin is highly volatile, we have a second metric called MNAV, market net asset value. If NAV is a basic metric used to measure how much value is in a share, then MNAV is a more advanced tool that better reflects the dynamics of the crypto market. MNAV equals total market cap of the treasury or company divided by net crypto holdings. Assume a DAT company has a $140 million market cap, holds about $100 million in Bitcoin, and has zero debt. Its MNAV would then be 1.4, which is a 40% premium. If MNAV is 1, that means the market's pricing perfectly reflects the net asset value. But if MNAV is greater than 1, the stock is trading at a premium. If MNAV is less than 1, then the company is underperforming, with its market cap below the total value of its crypto assets. Such assets are said to be sold at a discount. As Michael Saylor said, volatility is not a risk to avoid, but an opportunity to buy on the dip. Hold during turbulent times and let Bitcoin scarcity play out over time. Theoretically, an MNAV around 1 is considered reasonable, but in reality, the MNAV of these DAT companies is usually significantly above 1. In September 2025, Strategy's MNAV was around 1.5, and many other companies reached 6 or 7. The most extreme case I saw was a company called Kingly MD, whose MNAV hit 75. This means that for these DAT companies, they can leverage capital several times their own asset base. The market is always volatile, and because of that volatility, these DAT companies can arbitrage between the digital currencies they hold and their own stock. For long-term holders, given the growth potential, some are willing to pay this premium. Trading tokens still has barriers for most ordinary people, whether operational financial, legal, knowledge, or security barriers. However, we value the Bitcoin or any cryptocurrency allocated per share in terms of its future growth potential. So for many investors, being able to buy a stock to indirectly play the crypto market is a pretty good choice. Of course, risk and reward always go hand in hand. Many people only see the gains from the crypto stock linkage, but they forget that at its core, it's a leveraged bet on cryptocurrency price trends. For example, the company Kingly MD, once extremely overvalued, saw its MNVP fall from 75 to 0.7. UpXI, which raised $100 million to buy SOL, saw its stock price soar, but then a massive sell-off sent it crashing 61% in one day. So for ordinary investors like us, if you can accurately predict crypto price trends, choose companies with strong execution and financing abilities, and control your position size, this could yield higher returns than simply buying tokens. But if you just jump in because of hype, ignoring share dilution, earnings reports, and sentiment shifts, then what you're buying may simply be the bag someone else is about to dump. So what do you think about the crypto stock linkage? Is it Wall Street's new wealth code or just another financial scam? Share your thoughts in the comments below. And if you enjoyed this video, don't forget to like, subscribe, share, and save for more content like this.